my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your September 2021 market update. The stock market had a great run for the first half of the year, but as I suggested in my last quarterly commentary, a pause was in store. For the third quarter, the S&P 500 index, which is a measure of the performance of the 500 largest stocks in the U.S. that are publicly traded, returned just 0.58%. Small cap stocks were down 4.36%. International developed markets, which includes countries such as France and Germany, lost 0.45%. Emerging markets were the worst performing of the major stock indices, down a little over 8%, as stocks tied to China sold off on some issues in the real estate sector. In positive news, commodities were up on the quarter, while bonds, both investment grade and high yield, had small absolute returns. On a quarterly basis, I'd like to share some market insights and our outlook with you. We believe that any investment strategy should start with a broad assessment of the economy and the markets, but as you can imagine, these can be complex topics. So I like to simplify our insights by answering three key questions for you. The first is, does the economy look healthy going forward? Second, are stocks cheap or expensive? And third, is the current market trend weak or strong? Meaning, is the market likely to change direction soon? So let's start with the economy. On a forward-looking basis, does the economy look strong? Well, one of the ways we can assess this is by looking at a chart of the leading economic index, or LEI, which is shown here. The LEI is comprised of 10 different economic variables that indicate the short-term future course of various sectors of the economy, such as manufacturing orders. And as you can see on this chart, historically the LEI, which is indicated by the blue line there, turns down prior to a recession occurring, which is the gray shaded area. And then it turns upward again before an expansion. The exception to this was 2020 because you can't forecast a pandemic-induced recession. The latest reading of the LEI was released on September 23rd, and it was better than expected, with 8 of the 10 indicators reflecting positive contributions. And this suggests that despite the Delta variant, continued supply chain shortages, and fears of rising inflation, the economy is likely to remain robust in the near term as the reopening resumes and as companies try to rebuild inventories. So overall, we'll say that this indicator is positive. Next, we'll look at asset prices, also known as valuations. And this helps answer the question, are stocks cheap or expensive? If stocks are cheap, we may want to overweight stocks versus bonds. If they're expensive, we may want to take some of our profits. Well, this chart shows the valuation on the S&P 500 index. And as shown on this chart, on a forward-looking basis, stocks are selling at approximately 20 times forward earnings. So to interpret that, this means that investors are willing to pay about $20 for each dollar they're expected to receive of future earnings. Now, relative to its 25-year history, this is on the expensive side. However, I will note that the market is cheaper than it was just a few months ago. And this is not due to a big pullback in the markets, but rather due to very robust earnings, which is in the denominator of the equation. It's also important to note that this isn't the only asset class that we are investing in, and how expensive the market is relative to other asset classes matters. There are other areas of the market that look cheap relative to the US, such as international and emerging markets. And in addition, relative to bonds, stocks are still cheap, which is one of the reasons why the market has been able to continue its upward ascent. To give you a visual, this is a chart of the income you can expect to earn if you decide to invest $100,000 in a savings account or money market account. Today, the average investor will earn $70 on a $100,000 investment. And this is significantly below the amount needed to keep pace with various measures of inflation, with headline inflation needing almost $4,000 annually in order to keep pace with that. So investors in savings accounts are locking in losses when investing in these areas. So to summarize here on valuations, or how expensive the market is, we'll say that this is neutral, as stock market prices remain elevated relative to their own history, but are still attractive relative to other asset classes, such as bonds or cash. Now let's answer our third question. Is the market trend strong or weak? And we like to answer this question by looking at what is known as market breadth, which is simply a measure of how many stocks in the index are participating in the uptrend. If the number of stocks in a strong uptrend starts to fall, that means that fewer and fewer stocks are holding up the index. And that's what's shown here. On the top of this chart, the dark blue line, you'll see the S&P 500 index in a strong upward trend for many, many months. However, beneath that, the red line shows the number of stocks in the S&P 500 that are in uptrends, and that's been falling for many months. So this means that while the market has been going up as a whole, fewer stocks were actually supporting that upward ascent. And last quarter, I shared with you that due to what we call fading participation in the market advance, because there are less stocks trending higher within the index, we expected to see a pullback or at least a pause in the market advance. And that did come to pass in September, with the market falling just short of 5%. Now, this is something that we watch on your behalf. So we rebalance and reposition portfolios in anticipation of this. Currently, about 71% of the stocks in the S&P 500 are in an uptrend, which is a healthy level, but I'm not convinced that we have bottomed quite yet. While market declines may be unsettling for you, especially given the rare occurrence over the last year and a half, it's important to remember that some back and forth movement in equities is normal during a market cycle. So what's keeping you up at night? One of the biggest concerns I'm hearing from clients right now is the debt ceiling. The debt ceiling was created in 1917, and it is the maximum amount of money that the U.S. can borrow cumulatively by issuing bonds. When the U.S. national debt levels bump up against the ceiling, which effectively occurred back on August 1st of 2021, the Treasury Department must resort to extraordinary measures to pay its bills. Otherwise, the U.S. will be in default on its debt, which would be catastrophic. So, for example, if Congress does not raise the debt ceiling by the date they've set of October 18th, and this is what could happen. So payments to the armed forces and other federal employees, Social Security recipients, and Medicare would be suspended. This payment freeze would likely cause a wave of layoffs and a hit to consumer spending, likely sending the U.S. back into a recession. The credit quality of U.S. debt would most likely be downgraded, and this would increase future interest payments on federal debt, which would only make the current fiscal condition of the U.S. worse and bring forward the urgency of tax hikes. And it would also increase interest rates, which would trickle down to increased rates on mortgages, credit cards, auto loans, etc. So as you can see, there are some very far-reaching and long-lasting negative impacts if the debt ceiling is not raised, which is why historically it has been increased. So just to give you some historical context, how often has this been an issue before? Well, according to the U.S. Treasury, the debt ceiling has been raised, extended, or revised on 78 separate occasions since 1960. This occurred 49 times under Republican presidents and 29 times under Democratic presidents. Now, obviously, that calls into question the effectiveness of having a debt ceiling in the first place, but that's beyond the scope of this commentary. But overall, while this is a significant issue for the economy, if the debt ceiling is not raised, our base case is that the debt ceiling will be raised by the cutoff date of October 18th. So while Senate Republicans have expressed an unwillingness to budge on the issue, Senate Democrats have the ability to pass a resolution through budget reconciliation, but the timing will be tight. So we expect that this will be resolved, but probably not until the very last minute. So as such, I would not be surprised to see some continued volatility in the weeks ahead until this gets straightened out. Looking ahead, the U.S. economy is recovering, but as expected, the rate of growth has slowed. The Delta variant and ongoing supply chain issues appear to be causing short-term headwinds to economic growth. However, the Delta variant appears to be peaking, and we're hopeful that some pandemic-related issues recede heading into 2022. However, supply chain issues, especially related to semiconductors, are likely to continue through the calendar year of 2022 and maybe into 2023. But overall, leading indicators of the economy remain strong. Interest rates have risen sharply over the last few weeks, but we expected this given recent readings on inflation. And while we expect inflation to be higher than we have been accustomed to over the last decade, it seems likely that we are not embarking on a period similar to the 1970s. And it's also worth noting that our portfolios have already been positioned for a rise in interest rates and continued inflationary pressures. Recent market volatility reflects a broader distribution of possible outcomes, especially as it relates to the debt ceiling and fiscal spending. However, volatility is normal in a market cycle, and we do remain constructive on the outlook for the economy as well as for risk assets, and expect that equities can move higher into the beginning of 2022. I want to provide you with a quick update on our clean water well projects to close out this commentary. As a reminder, clean water technology is a theme in our portfolios, given the water scarcity issues that we are encountering globally. Water stewardship is a financially material risk for many companies, and the access to clean water is a humanitarian issue as well. It's estimated that over 2.5 billion people lack access to safely managed clean drinking water, and it's estimated that 1.6 million people die each year from diarrheal diseases alone. So a few months ago, we partnered with UNTO, which is the humanitarian arm of CREW, to drill a water well in order to relieve suffering, restore dignity, and bring hope to those most in need. The cost to drill a water well is $15,000, and Beacon Wealth is providing matching gifts, dollar for dollar, up to $7,500. And I'm happy to report that we're almost halfway there. And that does include the matching gifts that Beacon has provided so far as well. We want to thank you for those who have contributed to this very important cause. Our donation page is listed on this slide, and I just want to note that gifts are tax deductible. We're hoping to fully fund this water well for people so desperately in need of it by the end of this year, and we encourage you to give if you feel so led. As always, we thank you for your continued confidence, and please reach out to us with any questions that you may have.